What if I told you your portfolio looks diversified, but it's really just one big bet? You might own an S&P 500 fund, maybe a tech ETF, maybe even a dividend fund. But here's the catch. All those might still hold the same top 10 companies. That means your money could rise or fall with just a handful of names, no matter how many funds you think you've got. It feels like you're safe, like you're doing the smart thing, but it's a bit of a trap. And that matters, because if you're counting on this to build wealth or retire someday, this hidden overlap can quietly increase your risk. Most people never notice it until it's too late. Now here's the twist. There's an ETF out there that quietly helps fix this, but most experts ignore it, not because it's bad, but because it's boring. And in investing, boring is often the thing that works. So let's open that door. I'm Mark. This is Dividend Hustle, and today we're going to look at a hidden ETF that might deserve a spot in your long-term plan if you can handle the way it behaves. Back when I started investing seriously, I thought I was doing everything right. I followed what everyone else seemed to be doing, bought the big-name ETFs, chased the high dividend funds, picked a few trending stocks that felt safe because they were popular. Honestly, it felt comforting, like I was part of the crowd, doing the smart thing. No one wants to be the odd one out. But over time, something started to feel off. Even though I had different ETFs in my account, they all started moving the same way. When the market dipped, they all dipped. When tech stocks had a rough week, my whole portfolio felt it, even my so-called dividend ETFs. And that's when I realized my diversified plan wasn't really diverse at all. It was just the same risk dressed in different outfits. I was chasing popularity or chasing yield. Both made me feel smart until they didn't. That's when I stopped and asked a different question. What if there's a part of the market that's not packed with everyone else's money? What if I'm missing something on purpose just because it doesn't feel exciting? And that question led me somewhere unexpected. There's a corner of the investing world that barely gets talked about. It doesn't trend on social media, it doesn't show up in flashy newsletters, but it's been sitting there, quietly, offering a different kind of opportunity. It's called a small cap value tilt. I know, sounds like a mouthful, so let me explain it simply. Small cap just means smaller companies, not tiny startups, but companies that aren't yet giants. Think of local banks, regional suppliers, niche manufacturers, real businesses, just not household names. Value means you're buying these companies at a lower price compared to how much they earn. You're not paying top dollar. You're looking for good deals, companies that make money but aren't popular right now. So when you hear small cap value, all it really means is smaller companies selling at cheaper prices. And here's the thing. Many of these companies are profitable. They just don't get attention. They're not exciting, they're not trendy, but they can quietly grow and pay back investors over time. Now, I know what you might be thinking. If they're cheap, are they cheap for a reason? And that's the exact question we're going to tackle next. Because yes, some cheap stocks are dangerous, but some are hidden gems. So how do we tell the difference? Let's go there next. Here's the trap most people fall into, myself included. We hear the word value and we think it means a good deal, like buying something on sale. Cheap feels smart. It feels like we're outthinking the market. But in investing, cheap can also mean broken. Some companies are cheap because they're unloved but solid. Others are cheap because they're weak, falling apart behind the scenes. It's like going to a discount store. Sometimes you find a great product at 70% off, but other times it's just junk no one else wanted. That's the big problem with small value stocks. Yes, they can outperform over time, but many of them are cheap for a reason. They might be losing money. They might be drowning in debt. They might be stuck in a dying industry with no plan to grow. And if you blindly buy a basket of cheap stocks without filtering out the junk, you're not investing. You're just collecting clutter. So the real edge isn't just buying what's cheap. It's buying what's cheap but still strong. And that brings us to the filter that makes all the difference.
there's one ETF that does something a little different. It's called AVUV. That stands for Avantis U.S. Small Cap Value. And if you've never heard of it, you're not alone. Most investors don't talk about it, and most big voices in the space barely mention it. But AVUV is built around a simple idea. Find small, cheap companies, but only the ones that also show signs of strength. AVUV doesn't just chase value, it filters for quality too. That means the companies inside tend to be profitable, not just not losing money, but actually generating real income. So while it still rides the small cap value train, it tries to skip the broken down cars. Now, let's be clear, AVUV isn't magic. It still goes down when small cap value goes down. It can still underperform for years. But it's been designed to give you better odds by avoiding some of the junk that drags other small value ETFs down. It holds over 700 companies spread across industries, and its expense ratio is 0.25%, higher than the basic index funds, but far lower than most actively managed options. So why don't more people use it? That's the next mystery we need to unpack, because the reason it skipped might be the same reason it works.
Most people skip over ETFs like AVUV, not because they're bad, but because they're hard to explain. Let's be honest, small cap value with a profitability tilt doesn't sound exciting. It sounds like homework. And nobody wants to buy the boring thing, especially when the flashy stuff just went up 30%. That's where human behavior kicks in. We all tend to chase what just worked. It's called recency bias. If tech stocks are hot, we want more tech. If Bitcoin doubles, suddenly it feels safe. But long-term investing isn't about chasing what's hot. It's about planting seeds that grow even when nobody's looking. AVUV and small value in general can underperform for years. Sometimes it lags the market for 3, 5, even 7 years. And during those boring years, it's easy to say, why am I holding this? But then something shifts, the cycle turns, and small value suddenly plays catch-up fast. By the time that happens, most people have already quit. They jumped out right before the rebound. That's why this ETF gets ignored, because it's not built to win every year. It's built to quietly win over time. So here's the real question. Who is this actually for? And how much is the right amount without throwing off your whole plan? To answer that, I want to break this into 3 simple investor types, and I want you to think about which one fits you right now. First, the accumulator. You're building, still in the grind, maybe in your 20s, 30s, or early 40s. You've got time. You can handle some bumps along the way if it helps you grow more later. Second, the planner. You've been building for a while. Now you're thinking more about balancing growth with safety. You don't want to mess it up, but you still want your money to work. Third, the retiree. You're in the preservation stage. Your biggest goal is to protect your income, keep things steady, and sleep at night. So how does AVUV fit? For accumulators and planners, it can be a smart add-on. Not your whole portfolio, but a small slice. A second engine that runs in the background, slow, steady, and sometimes boring. For retirees, it might be too bumpy to play a big role, but even then, a small position could still help with long-term income if used carefully. Now that you know where this could fit, here's the bigger question. How do you actually add it without messing up your whole plan? Let's walk through that next. Let me show you how I personally think about using an ETF like AVUV without letting it take over my whole plan. It starts with something simple I call the core plus tilt setup. Your core is your foundation. This might be a total U.S. market fund like VTI or a basic S&P 500 ETF. It's broad, low cost, and built to capture the overall market. That should be the biggest piece of your portfolio. It keeps things steady. It gives you something to hold through the ups and downs. Then comes the tilt, a smaller slice of something different. In this case, AVUV. The goal of the tilt isn't to replace your core. It's to add something that might grow differently, something that doesn't move exactly the same way. But here's where most people mess it up. They get excited, go too big, and then panic when it underperforms for a while. That's why position size matters. Keeping AVUV as a small part, maybe 5 to 15% of your total portfolio, helps you stay in the game when it feels uncomfortable. Because the truth is, the biggest danger isn't the ETF itself, it's how you react to it in a bad year. When your tilt is too big, your emotions start running the show, and that's when smart plans fall apart. So build your core, keep it strong, add your tilt carefully, and make sure your setup is something you can actually stick with, because discipline beats strategy every single time. And now that you know how to structure it, let's talk about the one rule that makes this whole idea work or fall apart. Here's the one rule that makes this whole idea work. You can't judge it in 1 year. That's the hardest part, because we all want results now. We want to feel smart fast. We want proof we made the right choice. But real investing doesn't work that way. This isn't a sprint. It's more like planting a tree. You plant the seed, you water it, and for a while, it just looks like dirt. But underneath, something's happening, slowly. And if you get impatient and dig it up after a year to check progress, you kill the whole thing. That's how people treat smart investing strategies. They buy them, they wait a bit, then when it lags or looks boring, they dump it and move on. That's loss aversion. It's human, it's normal. But it's also what separates the people who build wealth from the ones who keep starting over. So, if you're going to use something like AVUV, you have to give it time, years, not months, because the real edge isn't picking the perfect ETF. It's being the kind of investor who can hold on to it when it feels wrong. And now that you've got the insight, what should you actually do next? Let me leave you with 3 quick checks before you add any smart ETF like AVUV. 1, is your core in place? If not, start there. Build the foundation. 2, can you hold this when it underperforms for a while? If not, keep your portfolio simpler. 3, are you doing this because it fits your plan or just because it feels exciting? Because excitement fades, but discipline sticks. In the next video, I'll show you how to build a simple, steady dividend hustle-style portfolio, one that includes a strong core, growing income, and 1 or 2 smart tilts like this one. No noise, no chasing, just a clear path you can actually follow. Until then, I want to hear from you in the comments. Are you an accumulator, planner, or retiree? And what hurts you more, FOMO buying or panic selling? Let's talk about it below.